impression many people have of the financial industry is that it's dynamic and innovative. But is that really the case? A new book about the active fund management industry suggests the opposite is true, that it's characterised by inertia. Indeed, the book is called Inertia, Purposeful Inefficiencies in Financial Markets. And in this episode, we talk to two of the authors, Professors Yuval Millo from the University of Warwick and Crawford Spence from King's Business School. Millo, Spence and their colleague James Valentine interviewed about 70 active managers and equity analysts from Britain and the United States. One of their more surprising findings was that many of those who work in the industry don't even use active funds themselves.
We interviewed about 70 people and not everybody expressed this view, but a significant enough minority did to pique our interest, and on both sides of the Atlantic. We were hearing active fund managers or equity analysts saying all my own money is in index funds.
The interviews also revealed that by punishing those who make mistakes, the industry encourages mediocrity.
If your mistake is obvious, and it's obvious that you made a mistake on your own, you don't have a lot of bold calls left for you. If you made like one or two, maybe the third one, you'll be out.
So what does all this tell us about the future of active fund management? Will it ever change? And why do so many financial advisors still recommend active funds?
Our initial foray into this field sort of suggests that relationships between fund managers and financial advisors are quite strong. So there's a strong ecosystem there, and people are more likely to direct funds towards people they know.
Believe me, what Professors Millo and Spence have to say is really telling, not least because it reveals what people who work in the active fund industry honestly think. I started by asking Yuval Millo how the research came about.
There are many starting points. I personally started working qualitatively on financial markets, working from a qualitative perspective on the operation of financial markets long ago, actually, when I did my PhD in the previous millennium, actually. But this particular project started when Crawford and Crawford began with some interviews. They came to me and said, let's write a book, let's write a paper about sell side and buy side and how they interact. He had some interviews. We did a few more. We published a paper on that. An American DBA student who was a sell-side analyst, James Valentine, approached us and said that for him it was a breath of fresh air, because everyone has been working on financial markets and sell-side, buy-side interactions and performance and all that from a quantitative perspective, crunching the numbers, and he couldn't find any decent research that was actually talking to them. He said, hey guys, do you want to continue doing interviews? And we said, yes, please. Continued collecting data, and one of the results is the book that you see.
Crawford, who exactly did you speak to?
So we spoke to a mix of different people, as Yuval said, on both the buy side and the sell side. So the buy side, it's fund managers, those who are doing sort of conventional stock picking, holding portfolios of generally, say, 30 to 50 stocks. And their advisors on the sell side who work in investment banks, equity researchers, whose job, at least ostensibly, seems to be to provide advice to fund managers about which stocks are worth investing in particular industries. So we spoke to both of those constituencies, which are key parts of sort of investment management, if you like, in both the UK and the US. So we did interviews in London, in New York and in Chicago as well, which is of course a major financial centre.
Now Yuval, you changed the focus of your research, didn't you, on the basis of what the interviewees were telling you. Tell me about that.
Yes, we came to them with a very general set of guidelines for the topics, but really we were fishing for interesting topics. And one of the things that came up without us prompting it was that the sell side and buy side, who are part of the active investment industry, if you like, were either complaining or justifying how they are superior to the passive investment side, which is of course a growing trend in investment, the investment world. So yeah, and we've identified, as we started looking back into our transcripts, we identified a plethora of narratives about why they are superior, how the market and why the market needs them, and all kinds of stories that basically aim to legitimize their continued existence. And again, because they were not prompted to do so, that came as an authentic voice of a concern in the field.
So just to clarify, Crawford, you weren't specifically asking them about active and passive investing, but that's what they seem to want to talk about.
Exactly. I mean, we were asking them probably more technocratic concerns about, if you're an asset manager, what do you value in a sell-side analyst? Or, if you're a sell-side analyst, what is your unique selling point when you try and sell your services to an asset manager? And they started answering questions that we never asked them. And they were really vexed and concerned about the rise of passive investing. And when somebody starts answering questions you never asked them, sometimes that's a diversionary tactic, but in this case, it really seemed to be an indication of, well, there's something interesting happening in this space. Actually, we need to be paying attention to that. And so we started to peel the layers of the onion and see what was lying at the core of it, really.
Yuval, what were they telling you about active and passive?
One is that the markets would need them when there are volatile market conditions. Then they told us that the market would need them for better stewardship. They told us that the market or investors would need them because of the quality of the advice rather than just what the advice is. So if you like, they broke down or started making a case about breaking down performance. And of course, they spoke about price discovery, which basically says that if the entire market, that's a thought experiment we heard many times from them. If the entire market was basically be replicating one another, you would have stale prices. There won't be any representation of real value. For that, they would say, you need active investors. So these are the, if you like, kind of a gallery of their arguments.
Essentially, Crawford, they were trying to justify their existence.
Yeah, they were. And again, we weren't criticizing them or saying, what's the story with active fund management? You guys are, a big waste of money or anything like that. But they were proffering these arguments as if they were under threat. It really sounded like a community of people that were facing an external threat or menace of some sort, and they were trying hard to produce a narrative that justified their continued existence.
What I find particularly interesting about your research is that you actually discovered active managers don't necessarily invest in active funds at all, let alone their own funds.
Yeah. Well, this was one of those sort of bombshell moments in the middle of the interviews. We interviewed about 70 people, and not everybody expressed this view, but a significant enough minority did to pique our interest, and on both sides of the Atlantic. So in both London and New York and Chicago, we were hearing active fund managers or equity analysts saying all my own money is in index funds. Or one fund manager in New York told us, I wouldn't invest in my own fund. Which is incredible, really. So then we proceeded to probe them on this and sort of ask follow-up questions of the nature, well, is that not a contradiction? Your life and bread and butter is all built around this idea of generating alpha, but you don't seem to believe in it. And the response would be, well, yep, I can see the contradiction, but hey, it's an interesting job. It pays well. And, that's enough to keep me going, really.
Yeah. And they kind of followed up, not the same interview, but we heard that. And we also heard, I think I kind of alluded to that before, that this is a premium service. One of them said, if I had $5 million, yes, I would take an active advisor to run my portfolio. But for you and me, probably ETFs or index are better.
They call it a premium service, but
yeah,
when we talk about when we think about a premium service, we generally think of something that offers a better quality outcome. But
You're right.
almost invariably, active management doesn't offer a better.
Yeah, so this goes back to their, I don't want to say desperate attempts, but kind of repositioning their narratives to justify the profession or the set of expertise they belong to. So they would say things like, yeah, we offer better stewardship. And then they would say things like, yeah, but what about ESG? We offer better ESG awareness. And so on. So performance, because when we spoke about that, like, hey, you don't perform well once you take into account management fees and all that, they would come up with with breaking down performance to other more qualitative, less easily measurable. It's funny because this industry is obsessed with measuring performance. They would come back with all kinds of different dimensions of performance.
You've used the research, Crawford, as the basis for a new book, Inertia, Purposeful Inefficiencies in Financial Markets. The book argues that the active management industry deliberately wants to kind of hold back change. What forms does that inertia take? Give me examples of the way that the industry tries to keep the status quo, if you like.
Yeah, well, in some ways, I will give you the examples, but just to frame it slightly, in some ways these are not surprising because they are just very human ways of behaving. And we would see them in any organization, in any established institution. And I think one of the key insights of the book is to say that, finance is not different. We tend to have these dominant myths or ideas about markets as, driven by creative destruction or innovation or tearing up the rule book. And we put hero hedge fund managers like Ray Dalio or Ken Griffin on a pedestal, and just think of people who don't follow the rules and are constantly changing what they're doing and achieve incredible success, which is not always true with those two, but that's a sort of another story really. But what we saw were more humdrum sorts of aspects of human behavior. So I'll give you maybe 3 examples which I think are illustrative of this. One is, people like to hire their friends. And this could be, people on asset management side hiring sell-side analysts that they know are not necessarily the best, but they've been using them for several years and they have an established relationship. So, it's problematic to disrupt that. Or maybe, you're a junior fund manager or junior portfolio manager and you would like to change your roster of investment advisors from investment banks, but your boss went to school with them. Chicago's a small place, New York's a small place, London is a small place ultimately. So, you don't have the discretion to change that because that disrupts the networks. And, we see this in any sphere of human activity. Markets are not different. So that's one aspect. A second aspect is to do with really, hugging consensus. So a key thing that both fund managers and equity analysts like to talk about when they self-present is that they are somehow different or contrarian, So they try and come up with an investment thesis or an idea for investing in a particular stock at a particular time or divesting from it that's different from everyone else because they have a unique perspective, have done unique research, unique analysis, and they maybe will have a slightly unique perspective, but then they look around what everyone else is doing and they realize that, I'm trying to be unique, but actually now I'm an outlier and there's risk involved in that. I don't want to be the black sheep. If this goes wrong, I've got some serious penalties. People won't trust me again. They won't go with my convictions. So actually, it's safer to go with the herd. Even if I think they're going to be wrong, I will throw my lot in with them because if they're wrong, then we're all wrong, and I don't suffer an individual penalty as a result of that. So we found many instances of people giving us examples of where they would hug consensus and just go with the herd, even if it contradicted their better instincts, if you like. But again, all understandable, all very human, and who would ultimately blame them for that? And then the final thing really is to do with, a sort of more cognitive form of inertia, which is that, lots of people are using the same models. They're using the same forms of analysis. They're reading the same newspapers. They're processing the same information in the same way. What do you think, is your unique sort of selling point. If you have have gone through the same university program as someone else, has done the same CFA program, which is more prevalent in the US than the UK, and someone referred to this as CFA groupthink, you're not going to come out with a different investment thesis ultimately. You're actually going to be producing something that's very similar to everybody else. So, you've got hiring your friends, you've got people hugging consensus, the safety of the crowd, and you've just got, that same way of analyzing the world and analyzing particular companies, which I think different forms of sort of social inertia and cognitive or epistemic inertia, we might call them.
Exactly what Crawford said. I want to kind of sharpen how deep if you like, I don't want to say the pathology, but the problematic goes. First, the consensus, right? The public nature of consensus consensus numbers, basically the average, if you like, of the forecasts of different sell side analysts, makes it a very effective mediocrity promoting tool, as exactly as Crawford said. But think about it. It's a very useful tool because you want to find out at a glance, right? You open, Factiva or Bloomberg screen, and you want to see, where the street is at. So that's a very useful cognitive tool. But it also pulls you to the safe, kind of fuzzy average, because you're saying, hey, am I smarter than everyone else? If I use my very sophisticated model and it put me, I don't know, half a pound higher than everyone's, or the consensus, maybe I should move towards it. So there's self-censorship. That's one element. So we really need to be aware that the fact that there is that the notion of consensus, this reductive and public measure of the view of the street has some serious impact on the innovative drive. That's one. Secondly, based on what Crawford said on the interpersonal relationship, there's also corporate finance relations between organizations. And you see quite a lot of sell-side analysts who basically telling us, and on the buy side as well, hey, this guy was there, this sell side, not because of the quality of his research, which was absolutely rubbish, but because we knew that we wanted to have some corporate finance services later on, or in the past from the bank that he or she represent. See what I'm saying? So it's not just interpersonal, but also interorganizational. They all kind of lead to the same place, that there is processes that replicate existing social structures, basically inertia.
Crawford, was your impression that these fund managers you spoke to, that they accepted that they faced an existential crisis, that the industry might not exist in its current state in, say, 20, 30 years' time?
I think there's a bit of cognitive dissonance here. They know and don't know that something is going on. So, and a lot of them, although it was only a minority, they said, I invest in index funds. Almost all of them recognize the value of indexing for your average sort of investor, and even from an institutional perspective as well. So they weren't completely dismissing indexing as some sort of a whack job strategy. They all recognized there was value to it, but then they recalibrated and said, well, okay, so what can we do in this world where indexing is dominant? And I think they recognized that, it was increasingly hard to beat the market. But as Yuval pointed out, that there were still things that they could offer in terms of what they would call price discovery or bear markets. They seem to be particularly looking forward to bear markets all the time because they seem to think they'll be able to outperform index strategies in that scenario. I mean, the evidence doesn't necessarily bear that out particularly strongly, but it's certainly true that they look a lot worse in bull markets. So, they come up with these arguments, but there is a sense that, this is not a cyclical trend. This is a secular one that's going further. And actually, while they say we'll always need active fund management for various reasons, I think they know that the industry 10, 20 years from now is not going to be as big as it is just now.
Yes, we do need active managers to set prices, but we actually probably need far fewer of them.
I think that's true. I think that's true. And, you know, we did ask these questions of people, some of the more reflective people that we spoke to who were open to that and probably slightly less defensive about things. And we tried to ask them, you know, what number of people do we need? What should the ideal market look like? Is it 10% active, 90% passive? Is it 50-50? And, you know, we didn't really get concrete answers from people. It's inevitably a speculative sort of question, really. But I think there's a view from quite a number of people who, again, are working in the active space that the market could operate just as effectively as it does just now with far fewer active managers.
Yuval, just to clarify, when we talk about, or when you talk about inertia, you're not talking about laziness here, or disinterestedness, if you like. You're talking about deliberately trying to stop progress. So, yeah, give me examples of that.
Sure. I mean, it's right in the title, actually. Then this is kind of, we had back and forth on this. Inertia, the purposeful set of inefficiencies in financial markets. So, yeah, in a way, we identified intentional activities and ways of thinking that duplicated, you know, ways of thinking and habits and routines that made the markets less efficient. So we're talking, of course, again to the EMH, to the efficient market hypothesis. So yeah, as we said before, the fact that you're recruiting from a very specific pool of people, partly is because of trust, but of course this may lead to having a workforce around the industry that tends to think in similar ways. So inertia, we're kind of replicating the ways of thinking. This is, now I'm going beyond what is exactly in the book, but it's also related to the types of strategies that are being promoted. So the strategies themselves are not, you know, don't have a huge variety of ways of looking at the market. They come from a certain, you know, they cover a spectrum, but it's fairly traditional the way they go with that. What else? Ways of thinking about that. We see the same way of thinking about the models. You know, the models are shared among people and they're scrutinized in a way that pushes them towards being more similar. So innovative ideas are not weeded out specifically, but they're not supported as much as, you know, an innovative industry would have.
And even if you try to be innovative, just to build on what Yuval's saying, you know, we had examples from sell-side analysts who were trying to, you know, produce an investment thesis that was slightly contrarian, and they would send their model maybe to the fund manager, and the fund manager would be like, oh, this is very interesting, but, you know, you're out of consensus. You know, everyone else is, you know, is 5% lower or higher than you. Therefore, I'm a little bit nervous about this. So even when you try to be innovative, you get social pressure upon you from others who are more running with the herd, and that dampens it out. So, you know, you have inert behavior and routines and habits that develop because of those social dynamics as well.
And just following up on this, the industry, and we saw it in a few examples, is very punitive towards mistakes. If your mistake is obvious, and it's obvious that you made a mistake on your own, you don't have a lot of, as they said, you don't have a lot of bold calls left for you. If you made like one or two, maybe the third one, you'll be out. However, if you're along with everyone else and everyone else is wrong, fine, go with consensus. This is an almost verbatim quote. So you see, these are the inertic mechanisms, if you like, the things that duplicate inertia, ways of thinking.
Do you think there are any ways in which the fund management industry could actually make itself more relevant? Ways in which it could add more value, if you like?
Yeah, I think, you know, they could be more reflective on, you know, the social relationships around them. And this involves ways of thinking which they're not used to doing. They're used to approaching a particular company or scenario with, you know, a set of, you know, financial models or sort of technical expertise. And it's all about, fundamental analysis. Let's apply that. Let's look at the financial statements. Let's look at what the media is saying about the company. let's, do some discounted cash flow stuff, and, those are our tools for making sense of the company. What they don't do is think more about the behavioral aspects of what they're doing, or the nature of social relationships that are driving some of their decisions. So that requires, I think, a different set of skills and competencies that require sort of looking at the bigger picture. And that's something that could force them to be more innovative and probably take more risks. And it would be producing sort of more psychologically safe environments. But, as Yuval pointed out, there's a lot of tendencies towards conservatism in that space. But also, they probably just need to recognize that what they're doing is impossible. Study after study has shown that beating the market on a regular basis, virtually nobody can do it. And I think they're clinging on to the fantasy that that's possible. Because some people do it for some period of time. So why would you not think that person could be me? But maybe more honesty with oneself around that would lead to, a more reflective industry. But that's almost unthinkable in a sense, because, you got to jump out of bed every morning and tell yourself that you can, beat the market and generate alpha. To sort of jump out of bed in the morning and say, today I'm not going to beat the market and not going to generate alpha is not particularly inspirational story to tell yourself on the way to the office, is it? So psychologically, I think it's problematic. I think that the reasons that they're still wedded to active fund management, despite the overwhelming evidence that it doesn't work most of the time, are deeply ingrained and psychological and probably quite hard to shift.
Yeah, I want to add 2 more points to this. It goes really deeply. Now, you've seen a few exchanges, and I'm sure the listeners and viewers have been to a few exchanges. You see quite a lot of statues or paintings of bulls outside markets, right? There's one in Wall Street famously. There's another one that I saw in Shanghai. There's one in Sydney. How many bears did you see? I don't think there are many. People like like a bull market. Just like Crawford said, this is a good story, a hero story. I can come, I can beat the market, I can do this, I can do that. It's a great story, right? And people say to themselves, I can be like them, right? But it is really difficult. It's nearly impossible. So that's one. The other point is that the short-termism that is baked into the thinking of this industry is really making it even more impossible. If you take a longer window, maybe 3 years, 5 years, remember we spoke about it, and you take into account some inherent cyclicality and measure fund managers according to that, maybe you'd see different people coming into the market. Of course, they may be paid less. The ethos has to change basically for this type of inertia to be changed effectively.
Crawford, one of the roles of regulators like the Financial Conduct Authority, for example, is to improve outcomes for consumers. What is the call to action, if you like, for regulators reading your book? What should they be looking to do to improve the situation?
Yeah, well, there's various things, but you used the metaphor of a public good, which is interesting because one of the equity analysts we interviewed described himself as a public good here in London. Said, well, I might not provide value all the time in an immediate sense, but I'm there if you need me, and we're worth paying for because we keep markets honest. Yeah. And I think he used an example of a street light. That's something that people's taxes should go towards paying for, and the equity analysts the same thing, which was curious. But in terms of what could regulators do, I think spelling out more clearly, caveat emptor, buyer beware, really, particularly for retail investors, because I think there's a lot of misunderstanding or poor levels of education around what investment outcomes are likely to be if you choose particular products, or your average sort of retail investor or person who has a financial advisor wouldn't know much about active or passive investing, and they're kind of beholden to the advice that they're given, and that advice they get might be quite good, but in some cases it won't be. In some cases it will be somebody who's beholden to the active fund management industry and possibly, makes value destroying choices on behalf of their client. So I think there's not much education that needs to be done for people to come to be aware of these differences between active and passive investing. But having a minimum level there that is pushed by the FCA in a more forthright fashion, it's not just some sort of disclaimer in the footnote of an investment prospectus, and in much greater transparency about fees and greater transparency about investment performance. We are academics with PhDs in this stuff, and we can get access to performance data. But even then, sometimes we have to dig around and find credible stuff. Most people aren't looking up SPIVA scorecards or finding out information about how active funds perform. And whenever I have this conversation with a layperson, they're astonished. They're still astonished that most fund managers underperform the market, and they don't believe me, actually. So if that's the case, then the regulator's not doing enough to inform people about it.
Maybe it goes beyond what the FCA or other regulators can do, but just thinking kind of outside the box here, maybe they could demand some more diversity in the workforce. Get there, like we do in public on boards of public companies. If following the public good metaphor, if it is indeed a public good through the pensions and through others, maybe there should be a better representation of the population over there, rather than very specific segment that also kind of keeps on selecting itself. So there's another element of diversity injection into the thinking of fund managers.
They could get rid of management fees completely and just leave you only with performance fees. So if you're managing money for somebody, I know that happens in some instances now with some funds, and I think those funds we can be less critical of because they have clear incentives. They're not earning money for nothing necessarily. It's still a curious industry where you can earn lots of money for underperforming. Your assets will keep growing every year. You maybe have more inflows from clients, but you're not beating the market, but you still earn more money as a result of that. In most other industries or sectors, you wouldn't get away with that. Maybe it's heavy-handed to outlaw those things, but at least be much clearer to people what it is they're signing up for, I think, would go a long way to maybe putting more pressure on firms to change their ways.
Your book, Inertia, Yuval, looks specifically at the active fund management industry, but you're also starting to explore other areas of the financial market, aren't you? Particularly intermediaries.
Yeah, well, coming out of the book was the thinking that we really don't understand enough about intermediaries in a theoretical sense, especially about financial intermediaries. We need to understand the kind of the in-between positions, and the economic theory that dominates this thinking tends to see them as either as friction or as actors who introduce some other elements, principal agent and all of that. And of course, it is too impoverished a theory to understand what happens there. So between us in different projects, we started looking into financial advisors, into the relationships between investor relations in companies and these buy-side and sell-side actors. We looked at pension funds and how they react to the increasing demands from members and others to perform on a different set of areas. So it's way beyond what two people, of course, can do. So we call for other academics to look qualitatively into finance. There's woefully little that's been done on that, and there's a lot to understand.
Crawford, more and more financial advisors around the world are recommending passive funds and sort of systematic funds, if you like, rather than traditional active funds. But even still, the majority of advisors around the world are still advocating active management. Why do you think that is?
I think, we have some sort of conceptual explanations that would apply to this group as well, that are from the book, to do with habits and routines. And even though, sort of drip feed fees from active fund managers through to financial advisors have been taken away in many countries, so there's no direct economic incentive to, say, allocate all of a client's funds to active fund management. There are still sort of psychological anchors and reasons for doing so. So, our initial foray into this field sort of suggests that, relationships between fund managers and financial advisors are quite strong. So there's a strong ecosystem there, and, people are more likely to direct funds towards people they know, and people they're friendly with. That's normal behavior in many industries. So that is happening. There's also the sense that financial advisors feel uncomfortable just recommending pure index-based strategies to clients, because then what are they offering? The clients can almost pretty much do that themselves, even though some of them are not well enough educated to do that. But it doesn't take that much for them to then understand, the choice then is really between, do I go global equity fund, or do I do a bit in mid-cap? There's a little bit of decision making that needs done there, but most sort of semi-intelligent, half-educated people don't really need a financial advisor for those aspects. But financial advisors feel like they can, offer some value added or something special to clients if they say, I know of these active funds that outperform the market by certain percentages. Of course, there's no guarantee, but they've done very well in the past. And those can be quite persuasive arguments, I think, for people, because, who doesn't want to win the lottery, right? The imagery around these things in society is very strong, isn't it? So, there's these psychological reasons, habits, and still there's the possibility that you could get lucky there. That I think all explain why, financial advisors are to some extent still beholden to the active fund management industry.
Yeah, we see something similar with pensions, by the way. It's exhibited differently, but pensions are being pushed to perform stewardship, for example, with regard to climate change. But the more they invest in liquid assets, right, the more difficult it is for them to actually exhibit effective stewardship and try to affect, whatever, the FTSE 500, the FTSE 100. Good luck. That's not, you're not going to do any effective stewardship over there. So they're gradually being pushed, paradoxically, by their trustees and members to more and more illiquid parts of the market. For example, private equity, where they can actually bang on the table and say, right, I want you to do this and that. But they put you and I at risk, because it's much harder to get rid of those assets. So there's liquidity risk. There's also higher volatility that may come from areas that are not covered. All kinds of black swans may sail in. If you're buying, for example, 1/3 of Heathrow Airport, which is our pension fund actually bought, because they were asked to produce better stewardship. So you see what I'm saying? The element of the passivity, if you like, or the ability to affect your investment is really something that drives us into all kinds of paradoxical results time and again.
We have seen in recent years, exactly the same time as the SPIVA analysis and the Morningstar active passive barometer data and so on. In spite of all that, pension funds and endowments have increasingly been allocating to, private equity, private debt, venture capital, hedge funds, and so on. Why do you think that is?
One of the answers is what I just said now. Partly, that's not the entire answer, okay? But partly is that they are pushed to show more effective stewardship. So trustees and then, of course, the members behind them are telling the fund, hey, show me that you are showing ethics, that you are not investing in brown or polluting or arms dealing assets or assets that relate to them. Okay, it's very difficult for you to do it via the passive. You need, or by the usual, if you like, the fund management institutions that exist. You really need to go beyond them, especially for small pension funds. So that's one. Another point is basically the size of the funds in relation to the size of the pension funds, in relation to the size of the financial industry, puts the pension funds at a disadvantage. So many of them converge now to become, bigger, fatter players that can throw their weight around, or they try to become much more specific in the way they invest. So take risk, but having a lot more expertise. So I hope it answers your point about,
The argument about stewardship,
Yeah.
it sounds very spurious because after all, you could just simply invest in ESG index funds that exclude sin stocks and brown stocks and whatever else.
And yeah, and you can see a huge increase in all the different flavors of ESG, right? If you follow the funds, that's the fastest growing sector of ETFs. But two things happen. One, you cannot really show your worth as an intermediary if you basically turn around and tell your clients, you know what, yeah, we're going to put it in this ESG, and you go, yeah, but who runs this fund? Oh, someone else. Good, why am I paying you? So you need to show your trustees as a fund advisor, as a fund manager who talks to an advisor. Remember, the advisors need to be there by law, that you're doing something for them. What's a good way to demonstrate this? By selecting an asset. You see what I'm saying? Even if the asset is risky.
Crawford, we are seeing increasingly lawsuits, both sides of the Atlantic against trustees who, are going along with what investment consultants say and very often paying excessive fees and getting lower returns as a result. What do you think's going on here? Why don't you think trustees are, asking more rigorous questions of their investment consultants, for example?
Well, it's an empirical question, and I think it's one we need to tackle. Is probably the next wave of research to move further up the investment chain, if you like, because they're allocating the assets into the active fund management industry, and the active fund management industry is still as big as it is because they're getting all these inflows from pension funds and retail and institutional money. I suspect it's the same stuff that we're seeing with, say, financial advisors. We need to show that we are doing due diligence and that actually we're offering more than just the average. That we are doing a special job. We've done sophisticated analysis, and we've identified who we think are the top 5 to 10% of performing fund managers that we can allocate funds to, and they'll probably produce a case as to why those fund managers are the ones they should invest money with, and bolstered by the investment consultants. And maybe that's based on information from the last 5 years. But as we know, historical performance is not necessarily a very good guide to future performance, and nobody can predict the future. So, you'll see elements of, social relationships, sticky relationships, and sort of cognitive inertia that exist at that level as well, I've no doubt. And I think it would be interesting to flesh those out in more detail.
Absolutely. Plus, look at trustees of occupational pension funds. They need to represent the members, right? So I'll give it, I cannot say the names, but think about this, a supermarket brand that all of us know. I spoke with a trustee of their pension fund, and he basically said, look, I have to accept what my advisor is telling me, because what do I know about the market? I can tell you about how to run a supermarket very well, but I need to take his advice when it comes to my members' money. So it puts them, and another one from Steelworks up north, again, same story. What do I know about the financial market? I need to represent my members' interests, and I need to sign at the end of the quarter on basically on a document that says, yes, I take the risks that were represented to me and I pass them on. They have to rely on the advisors.
Yeah, and who is the investment consultants' relevant network? Who are they hanging around with? I mean, they're not a health and safety inspector running around with a hard hat and a high-vis vest. Their relevant community are the investment professionals that they're, analysing, spending time with, possibly going to work with in the future. This is their community. So they're we don't know enough about them, but it's quite possible they're part of the problem as well. And indeed, if there are lawsuits against them, then it seems like that would indeed be the case.
Yeah, which brings us back to inertia.
Exactly.
We've gone a full circle on this.
And that's an appropriate point at which to ask my last question of both of you.
Sure.
What do you think the future holds for the fund management industry?
We made a whole story about criticizing people who are asked to predict the future, so I wouldn't be coming out and try to be better than them, right? Especially not over the next 10 to 20 years. So the honest answer, I don't know. What I can say is that we identify forces that are at work. That is, one, financial markets are not different from any other social institution. So people tend to have their their interpersonal traits and their preferences to their friends and so on. And also when faced with risks, most people, even though they are hotshot financial advisors and the sell-side analysts, tend to be risk averse. As a result, you tend to have all kinds of consensus-related phenomena. So they tend to go for the path of least risk. So now, is this going to change? I don't think it's going to change. The forces are not going to change fundamentally because they've been in existence for thousands of years. What is going to change definitely and is changing is the ability to produce sell-side analysis. And I'm talking about AI. AI now is making a lot of the easy work or relatively easy and even intermediary work of sell-side analysts very, very easy and much, much cheaper. And I think that's going to be a big one in terms of investment advice. So that would be my stab into the future, if you like.
AI certainly has the potential to bring down fees, Crawford, but eventually, though, it's all going to come out in the wash because the markets are just going to be as difficult to outperform as they were before. Is AI really going to make such a massive difference?
Well, it seems like there's going to be, the early indications are there's going to be relatively sort of democratic access to AI, doesn't it? So that would create a level playing field. I'm a bit nervous about predicting the extent to which AI will change things. There's a lot of hype around that, so I'm not really sure. But I think that the direction of travel for fund management, there's still a way to go with fees coming down and market share moving more towards passive. And that might slow down at one point. And what is certainly clear that we point out in the book is that the active fund management community is not going to go quietly. You know, they've got too much skin in the game to produce justifications and arguments about why they're still relevant. And some of these arguments have some merit. They just, in the round, seem to be a little bit overblown. I mean, I was at an event recently in London where an active fund manager was being criticised for the industry's lack of alpha. And he undertook this sort of clever linguistic shift. He said, well, we don't need to talk about economic alpha. We can talk about organisational alpha. That's what we strive for. And then he sort of left it there, and then nobody picked him up on it. And I spoke to him afterwards. I said, what do you mean by organisational alpha? He says, well, you know, we can have good culture, good systems, good processes. It could be a nice place to work. And I thought, well, is that worth a 2 and 20 fee model? I'm not necessarily sure, but that's an example of the sort of linguistic gymnastics you see people playing with when they are clearly under threat and they're trying to produce a continued sort of raison d'etre for themselves. So, you know, they're still there, they're still relevant, but there are pressures on them that are quite significant.
Yuval Millo, Crawford, Spence, thank you very much indeed. That was my interview with Yuval Millo and Crawford Spence, co-authors of the new book, Inertia. We're very grateful to both of them and also to our sponsor, Timeline. Timeline provides best-in-class planning technology and portfolio management solutions that enable advice firms to deliver exceptional value to their clients. Enjoyed this interview? Well, why not subscribe? And while you're at it, please leave a comment. We love to receive your feedback. That's all from us for this time. Goodbye.